This time last week, investors were petrified of the possibility of contagion within the banking sector. 1 week on, the S&P's ETF of regional banks is 7% higher than it was this time last week. Want to know more? Keep watching. Hello, I'm David and this is Trading Today. We're seeing the S&P itself, the major index, trade up above 40.50 this morning. That's its highest level since around the 7th of March, just before Jerome Powell released his testimony in Washington. A very hawkish testimony, saying that the market had got it wrong and that the Federal Reserve was going to be raising rates a lot higher and holding them there for a lot longer to combat inflation than the market was giving them credit for. Roll on a few days later and a few banking collapses later, and how things had changed. Now we expect the Federal Reserve to take its key Fed funds rate up to a maximum of 5.25%. That's the upper end of its 25 basis point range. And by the end of the year, as far as the CME FedWatch tool is concerned, that's the real money, they expect the Fed funds rate to be down at 4.5%. Nowhere near the 6% terminal rate that many were betting on, as I say, near the beginning of March. Now, yesterday, the Financial Services Committee in Washington gave an absolute roasting to bank regulators, saying that they hadn't been transparent enough, and this had contributed to the scares that we'd seen across the banking sector. It almost seems like they are now old news, and indeed investors, as I say, are taking the S&P higher up to levels we last saw at the beginning of this month, above 40.50 briefly this morning. Can it hold? We'll have to wait and see. There's an awful lot to look out for. Now, we've just had the latest weekly jobless claims and also an update on GDP, the GDP number for the last quarter of 2022. Both came in as expected. We were, as far as GDP was concerned, plus 2.6% against plus 2.7% expected. No surprises there. And weekly jobless just bang in line, coming in at 198,000 compared to 196,000 expected, so no concerns there either. Tomorrow, much more important piece of news is going to be the update on core PCE, personal consumption expenditures. This is the Federal Reserve's preferred inflation measure. We really need to see that coming down for this market to continue going higher. Any sort of signs that inflation isn't beat, and it's going to really chuck the cat amongst the pigeons. So watch out for that one. But as we speak at the moment, the bulls are in charge. It's just a question of can they maintain that going into the weekend and the end of the first quarter of 2023 as well. Thank you very much for watching. I hope you found this useful. If you did, please like and follow. And as always, thank you very much for watching, and best of luck with your trading. Goodbye.